Have you ever noticed how the price at the gas pump seems to jump around? Or how global news about distant regions can suddenly impact your household budget? It feels like an invisible force is at play, constantly adjusting the cost of so many things we relying on every day. Well, the primary force driving crude oil prices is a dynamic balance between global supply and demand. Think of it like a seesaw, with one side representing how much oil is available and the other representing how much the world needs. When one side outweighs the other, prices react accordingly. On the supply side, several critical factors come into play. Global production levels are key, influenced by major oil-producing nations, particularly those in the Organization of the Petroleum Exporting Countries Plus, also known as OPEC+. Their decisions to increase or decrease output have a significant ripple effect. Geopolitical events, like conflicts or political instability in oil-rich regions, can disrupt production or transportation, immediately tightening supply. Natural disasters, such as hurricanes hitting offshore platforms, also play a role, as do technological advancements in extraction, like horizontal drilling and hydraulic fracturing, which can unlock new supplies of shale oil. These factors collectively determine the world's available oil. Conversely, global demand is largely shaped by the health of the world economy. When economies are growing robustly, industrial activity increases, more goods are shipped, and people travel more, all of which requiring greater amounts of energy. Transportation needs, encompassing everything from cars and trucks to ships and airplanes, are a huge consumer of crude oil. Seasonal variations also contribute. For instance, increased demand for heating oil in colder months or gasoline during summer driving seasons. Rapidly changing inventory levels, which refer to the amount of crude oil currently stored, provide immediate signals about current market imbalances between supply and demand. Understanding these key drivers allows you to better interpret news headlines and economic reports related to energy. When you hear about an OPEC+ meeting or a report on global economic growth, you can connect these events to potential shifts in crude oil prices. Paying attention to these signals can help you anticipate general market trends and make more informed decisions about your personal spending and planning. Crude oil is often traded through something called futures contracts, which are agreements to buy or sell oil at a predetermined price on a future date. These contracts are heavily influenced by the very supply and demand factors we just discussed, and their prices can signal market expectations for the future. Another interesting aspect is the Strategic Petroleum Reserve, or SPR, held by governments like the United States. This reserve is a stockpile of crude oil that can be released to stabilize markets during supply disruptions, acting as a buffer against extreme price spikes and adding another layer to the complex supply equation. Ultimately, grasping the interplay of these supply and demand elements empowers you to look beyond the daily fluctuations and understand the fundamental forces shaping the cost of energy. This knowledge can help you make sense of broader economic trends, prepare for potential changes in daily expenses, and feel more confident in navigating the world of commodities, enabling you to protect your money from market risks.